Good morning, everybody. Welcome. I call this meeting at NCUA Board to order. In addition to those joining us in the boardroom today, I want to note for the record that today's meeting is open to the public through a live webcast. Anyone watching online, if you want to view the closed captioning of this meeting, please click on the CC icon in the lower left of the WebEx. You can also change the layout to one you're choosing. Just click Layout in the top right. Recommended viewing is the stack view. If you're listening to me, the bad news is I have a sore throat and lost my voice a little bit. So the bad news, I can't talk much. That's bad news for me. The good news for you is I can't talk much, okay? Thanks, everybody, for joining us live or online. A couple updates before we move to the one item. This should be a quick meeting, by the way. I think we'll be out of here in 30 minutes or so. This has been a time of tremendous change for NCUA. You got new leadership, smaller workforce, new priorities, more changes coming. Many of those changes are going to be reflected in the agency's 2026-2030 strategic plan, which we aim to publish early next year. As part of that process, we held the first ever strategic plan town hall last week. The virtual event had representatives from credit union leads, QSOs, trade associations, et cetera. NCUA staff asked questions related to challenges those communities face and how NCUA can best support safety and soundness while encouraging innovation and growth. We got a lot of feedback on what's working, what's not working, what the community and writ large would like to see regarding regulation, deregulation, and what issues they see being important in the future. Even after the town hall, we got feedback through our Ask NCUA tool. Again, that is available 24 hours a day to anybody. Thank you to everybody who participated. This approach to strategic planning, which brings stakeholders into the conversation, is how I want to see NCUA approach its work. By listening, by asking questions, we learn more about the needs of credit unions, how we can achieve our goal of safety and soundness while reducing the weight of burdensome and inefficient rules and regulations, especially for small and de novo credit unions who often have very specific needs and challenges. Reminder, safety and soundness isn't necessarily in conflict. It's not necessarily in conflict with right-sizing the regulatory burden. In fact, if we right-size in a thoughtful manner, we'll make it less likely that America winds up dominated by a few large credit unions. Consolidation is not the friend of a regulator, and it's definitely not the friend of an insurer. NCUA, like any insurer, wants a diversified risk portfolio. It's better for NCUA to have a wide plethora out there of credit unions, as diverse in their business model as they are in their fields of membership. Our examiners shouldn't be telling credit unions that, you know, this isn't something we see at most credit unions, okay? That's feedback I've gotten. Or they shouldn't be saying that in a manner that discourages a diverse set of business practices at America's 4,400 credit unions. One thing that is clear following the feedback process is the outsized burden that obsolete, duplicative, and overly prescriptive regs can have on credit unions. And in 2025, NCUA, we're down over 20% of our workforce. So we at NCUA have an operational imperative to right-size everything that we do. Our current president started the most far-reaching reg reform in history. NCUA is proud to be part of that reform effort, and we're currently reforming our regulations to identify burdens that can be lifted. So that's that topic. You may notice I continue to be the only person sitting at this table today. As I said before, no matter what NCUA board looks like, the mission continues, and we're going to keep seeking ways to improve our effectiveness and efficiency. Speaking of efficiency, we're not having a board meeting next month, given our inward focus right now in October. I also want to correct something I said at earlier board meeting, which was that it turns out I said at the time, 2001 was the last time NCUA had a board meeting with just one board member. I was corrected, just want to lay that out there. That did happen in 01, single board member, it was Dennis Dollar at the time. But in the interest of accuracy, I stand corrected since I was alerted that 2005 seems to be when NCUA last had a one-person board meeting. Looking at our records, it was almost exactly 20 years ago when the then single board member, Chairman Joanne Johnson, ran a meeting that looked like this, with one at the table. The agenda, for what it's worth, that meeting, Chair Johnson approved a final rule, Part 713, related to fidelity bond and insurance coverage for credit unions. That rule she passed that time is still on the books today. The main thing is that NCUA insurance is as sound as ever. NCUA will continue to do business as usual, just as we did back under the sole board member at the time of Chair Dennis Dollar, Chair Joanne Johnson. And of course, at some point in the future, there's not going to be one board member. There may be 0, there may be 2, there may be 3. But regardless, my mission and that of my colleagues here is doing the best jobs we can on behalf of America's 140 million credit union members. In the spirit of, keeping up business as usual as best we can, but we're not going to have, there's no reason to have an October board meeting. We will have our annual public budget hearing. Okay, that is an open meeting, kind of like this, just downstairs. Stay tuned for when the exact time of that hearing. We'll also be publishing the staffed budget, the 2026-2027 budget. I believe that'll be next week, the staff budget, okay? Be on the lookout for that. To the one item, we have one item. Office of CFO will present the second quarter briefing on the performance of the Share Insurance Fund. Melissa, please join. Melissa, by the way, was recently named acting CFO. She will present this briefing. I'm also going to give one final shout out to our recently retired CFO, Eugene Sheehan. Eugene had a stellar career, and we wish him well in retirement. We're moving down to Williamsburg, Virginia. Eugene did a lot of things well. One thing he did well was his version of succession planning, meaning he knew for like 2 years he was going to retire at some point. Did a great job having Melissa, had Melissa at the table when she didn't have to be doing these. He did what you're supposed to do in those roles, which is make sure your departure, even if you're a rock star like Eugene was, is as less disruptive as possible. So have fun out there, Eugene. I kind of hope you're not watching this, because if you just retired,
he might be. He might be.
CFO, he might be, but you want to think he's doing something better. What's the point of retiring, right? He was still watching this. Anyway, begin when ready. Melissa.
Thank you and good morning, Chairman Hoffman. In today's update, we'll present the Share Insurance Fund dashboard. Beginning with the executive summary, we'll review key takeaways before covering the reserve, equity ratio, investment portfolio, and CAMELS data. The Share Insurance Fund reported $82 million in net income during the second quarter of 2025. Net income increased by $2.2 million over the first quarter and decreased by $4.2 million as compared to the second quarter of 2024. The increase in net income for this quarter was due to $9.2 million higher investment income, partially offset by $6.8 million in the provision for insurance losses. The fund total assets increased to $23.2 billion. The $0.2 billion quarterly increase was primarily due to a $170.6 million reduction in unrealized investment losses. Looking at the reserve, the fund records a liability consisting of reserves to cover actual and potential future insurance losses resulting from credit union failures. The second quarter reserve balance was $237.5 million, a decrease of $4.5 million from the previous quarter. The quarterly decrease was due to a $10.3 million decrease in the general reserve, offset by a $5.8 million increase in the specific reserve. There were 4 credit union failures during the second quarter, resulting in a loss to the Share Insurance Fund of $17 million. Next, we'll discuss the equity ratio, which was 1.28% as of June 30th, 2025. The decrease of 2 basis points from December 31st, 2024 can be attributed to a 2.9% growth in insured shares. The fund's equity as of June 30th could have withstood a loss of $1.4 billion without dropping below the 1.20% threshold requiring a restoration plan. The projected equity ratio for December 31st, 2025 is 1.30%. Moving now to the investment portfolio. The yield was 2.68%, up 8 basis points from the first quarter. The fund maintained a balance in overnight investments of $5.5 billion to ensure liquidity is readily available without incurring a potential loss. During the second quarter, 8 Treasury notes matured for a total value of $750 million. These securities had yields ranging from 0.33% to 1.76%, and the proceeds were reinvested at higher yields. Our latter approach maximizes the fund's long-term earnings stability and better protects against potential market fluctuations such as downturn in interest rates. Turning now to the aggregate CAMELS data, which remained stable in the first quarter. The total number of credit unions was 4,381, a decrease of 34 from the end of the first quarter. The percentage of insured shares in the CAMELS Code 4 or 5 category was 0.7%, a decrease from 1% at the end of the prior quarter. The Camels 3 category was 9.2%, an increase from the first quarter's 8.2%. Over 90% of insured shares were rated in the Camels Code 1 or 2 category, supporting the conclusion that the Share Insurance Fund continues to be in good financial condition. In closing, I'd like to highlight our enhanced public access to the Share Insurance Fund dashboard. This platform is compatible with a variety of devices and incorporates features that support accessibility for users. The improved experience allows users to navigate topics by clicking through sections, tabs, and resources using live links. The site has interactive visuals that allow hovering and selecting data points to display underlying details. And lastly, the drill-down insights such as breakdowns of income and expenses are accessible in more depth than the summary. Much credit goes to the team that created this true digital presentation of the Share Insurance Fund's financial performance. I'd like to specifically thank May Sue, Namir Perez, Kenneth Hodge, Olivia Ranakasuma, and Ben Hardaway. This vision wouldn't be a reality without their collective energy and can-do attitude. That concludes my presentation. I'm happy to answer any questions.
Got you. Congrats again on your new role. I will mention that one thing that affects the budget, the White House has kept its hiring freeze, okay? It's up to them when they do it. They usually announce it in 90-day chunks. What's the current one till the end of the year, I think? December? Okay. The first Trump administration, that hiring freeze went until June of 2018, right? So let's just say if it followed that clock, and it may not, that would be June of next year. One thing that would help us is when they do their final 90-day extension, it would be nice if we knew that was the final 90-day to give us time, because the federal hiring process takes a while. You can't just say, oh, the hiring freeze got over-announced. All right, tomorrow, all these people start, sign up. And this affects you, Melissa. Honestly, the hiring freeze, the only way we should have, the bigger effect is not just adding new full-time employees, right? It affects the budget. That will obviously happen. There's some roles we'd like to fill when that's lifted, a few of them, right? We're still going to have a large savings here, but there's some roles that we'd like to fill, adding total FTE, right? The main effect that I've seen, I think everybody who works here agrees, the main short-term effect is we can't fill roles even permanently. We have all these, vacancies and promotion opportunities, and, you're acting, we can't name you full-time CEO. We just can't. And there's roles we can't even fill, and we can only do it temporary, and temporary has, a time limit. So anyway, I just want to say that the one of the variables in our budget, and obviously everything eventually comes out of the SIF one way or the other. There's only one pot of money, and it's the money from credit unions, right? It directly or indirectly comes out of credit union members' pockets. But anyway, I just want to say that about the hiring freeze, because that's worth saying over and over, because we still have people who say, why can't I be promoted? It doesn't affect full-time employment. I'm already here. There's no change. Why can't I be? Well, that's because that's what the hiring freeze does. Anyway, I just want to say that. But big picture here, good news to say it, the fund's staying strong or resilient. I noticed that even at the end of June, par value 24 billion, cash value 23, which means some of them are underwater, but not what it was. Obviously, yesterday the Fed lowered rates, right? Now that's just the short-term rate. So the way the Fed does it these days is they do a range of a quarter. They didn't used to. So yesterday morning, the Fed's overnight rate was 4.25 or 4.5%. This morning, it's down 25 basis points, right? As of right now, it's 4% to 4.25. That's the Fed overnight's rate, right? That, in effect, is where financial institutions borrow from the government. The reason that matters is no bank or credit union is going to lend you money cheaper than they can borrow it, right? So that's the base rate for short term, right? And this is, lower interest rate cycles in the short run are good for our portfolio, but it all depends on expectations, right, Melissa? The same way that the Fed rate hikes hurt our portfolio when they're unexpected and if they're not already baked in the cake. In terms of what's already baked in, just so you know, and I'm not predicting anything, I'm just relaying, I just checked. The current market is Christmas this year, by December, the market is pricing in another 50 down, okay? That's the modal outcome. It's like 80%. So you wake up on New Year's Day, the market says the most likely outcomes were down another 50, right? So that'd be 75 basis points of cuts by the Fed from where we were yesterday morning. 1 year forward, December 2026, okay? This is just the market, what they're doing. The modal outcome is kind of tied between being 2.75% to 3 and 3 to 3.25, okay? Those numbers represent 150 basis points of cuts in this cycle or 125 basis points of cuts, right? Again, that's just what the market is, and, you know, if I could accurately predict interest rates, I would have a private jet. So, one thing to mention, 4 credit union failures. Last time we did this, there was 0 in that quarter. There's 4. Credit union failure is a negative. It's one of the worst parts about this job. They incurred a loss of $17 million. So at the end, total credit unions was 4,381. So I use 4,400 when I'm speaking, just to make sure I'm ballpark right, okay? Closing credit unions, especially small and newly chartered ones, is disappointing. Nobody, including us, went through all that effort to see it closed and see it taken over. And we certainly didn't go into all that effort to then have to write a check, but that's what insurance is. Part of having a thriving credit union system is having member trust in the financial institutions, and closings make people nervous. But allow me to share the credit union membership overall grew in that second quarter, as Melissa mentioned. Shares and deposits increased at the median credit union, and at 88% of them had positive year-to-date net income. So more total deposits, more total income across the system. My point here is that 4 failures is not fun, but if you're looking for a canary in the coal mine, I don't think you're going to find it there, okay? And am I correct? So we had to net write check for $17 million, okay? That's what insurance does. But the total insured assets at those 4 was about how much total? Is 100 a decent number?
We think, Masood, you can pull up the chart for the credit union losses.
Part of my point here is just reiterating that when you hear a $100 million credit union goes into conservatorship.
So the assets are 61.
60? Okay, 60, okay. So it was a total of 60, but we only had to write a check for 17. That metric is not too far off from the long-term order. The point is that when somebody does hear, because it will happen at some point, a $100 million credit union, a $500 million credit union, when it comes to faith in the system, can NCUA pay? Is it going to nail the share insurance fund? Whatever that top line number of deposits are, on average, it's only a smaller portion of that we actually have to write a check for, right? For these 4, let's call it 60 million that we actually insured, we only lost 17, okay? That's, I think, important to know. Can we talk about this dashboard that you did? I think that's important to know because it's more transparency we're giving out to the public. And you guys did a great job with it. First of all, it's more aesthetically pleasing. It's easier on the eyes. It's more external. You can dig. The hovering over feature, I think the last time we did this, correct? That was not done? Where you could hover over and dig into it, right?
Right, well, it was done for those internal to NCUA.
But not external facing.
But not accessible for those that were outside of our firewall, right? But now they do have the access to those extras.
And it's backdated too, right? You can go back to the history?
Yes.
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 One point here is that the credit union trade publications, media who write about the fund, my colleagues here at NCUA, there's a whole bunch of new information you don't have to ask somebody for if you can just play around with this tool, right? So great work on that. So let's go back to the 4 failures. Any challenges? Can we read anything into those 4? Does it mean anything, right? I always use the analogy that, you know, I want to make sure we publicize as best we can, respecting privacy, why something failed. It's good for every board member at all 4,400 credit unions to be aware of this, right? Because it's lessons learned. I compare it to, you know, on the highway and you see some awful car wreck on the side of the highway. The only silver lining of that is it's a reminder to the rest of us, you don't want to be over there. Eyes on the road, be safe, right? That's the only positive, and it's important to get that lesson, okay? Any lessons, these 4, does it tell us anything? What's going on with these 4? Should anybody read into it, and should the other remaining 4,400 credit unions, any lessons they can take?
Sure. While specific conditions within each institution did vary, there are some key factors that we identified in the credit union failures year to date that were risk management weaknesses, operational deficiencies, persistent net losses, high operating expenses, and lastly, governance and leadership issues. So enhancing risk management practices, improving operational efficiencies, and ensuring robust leadership could help mitigate these risks and decrease the likelihood of future failures. As a reminder, we do offer lessons learned content on our website, and that summarizes weaknesses that led to historical failures and identifies the leading practices that credit unions may consider in their own operations to avoid similar problems. And that concludes my response.
Gotcha. My opening remarks, I mentioned that public budget hearing, I mentioned October. It is possible. That's the beginning of November. We have a process we have to go through before we can announce that. But Melissa, can you talk about, all right, how are we doing compared to the budget we did last year, right? We passed the budget, we're going to spend 2025, right? How about the 2025 budget we passed? How are we, the process, how are we doing against that budget?
Sure, yeah, pretty great. And you already mentioned some of the important things that we would want to talk about when explaining the budget for 2025. There were two significant changes aligned with the new administration's policies that impacted our budget. One was the voluntary separation program for NCUA employees, and then the second was a reduction in planned contract spending. Further, as you also mentioned, we paused hiring new employees for the time being, so that was also consistent with administration policy. A total of 259 eligible staff are participating in the voluntary separation program, and that will end their employment with the NCUA no later than December 31st, 2025. These separations, for which participating employees will be paid a financial incentive, are projected to cost the NCUA $13.6 million more than budgeted for employee compensation in 2025. These separation costs can be partially offset by compensation amounts budgeted for vacant positions that have not been filled in 2025. The NCUA's offices also identified $15.7 million in lower priority services and reduced their contract services budget by that amount. Through August, we're on track to maintain this lower level of non-payroll spending, part of which will be used to pay for the costs of those employees enrolled in the voluntary separation program. In addition, we project modest surpluses for the 2025 travel budgets due to the agency's reduced staffing. The draft 2026 budget, as you mentioned earlier, will be released soon and includes projected surpluses from 2025 and reduces the level of next year's funding proposed for board consideration. More significantly, however, because of the staff departures from the voluntary separation program, the 2026 budget for employee compensation will be substantially lower than previously planned. That concludes my response.
All right, thank you. So to review, for lack of a better term, the buyout programs that we gave, nobody was straight up laid off, right? It was all a pretty good deal, better deal than I ever got. Buyouts cost money up front. It's cash. But just to review, the sweeteners, let's say, we gave for early retirement, that's cash out the door. But even with the sweeteners, you said 13 point something million, that we didn't budget last year. We didn't know last year that we were going to have all these buyout sweeteners. That's money out the door that we didn't budget for. But that is more than made up for by the actual savings. Is that correct?
It is made up for, yes, in our lack of filling vacancies and then also contract budget services plus travel. So some of the things I mentioned do.
So two final
Offset.
points, and then we'll be out of here by 10:30, as I thought. Reminded everybody that unlike a lot of the cabinet agencies across government, if you guys remember that fork in the road email that went out, a lot of agencies, their buyout deals were through September 30. September 30 is the government's standard fiscal year. That's why it was September 30. Which means that starting in October, all those agencies have this great thing called cash to have, okay? We didn't participate in that for a variety of reasons. Ours is all through December 31. We have, most of the employees, the 259, are already out of the building, you know, turned in their phone and all that. But we have a little bit of a cliff in December too, right? So we don't have any of this cash until 2026, okay? Because we're paying everybody through December 31. This is different than what you saw at most of the other government agencies, okay? So we don't have savings in the year of 2025. Most agencies do, we do not. Some of the issues that we run into, we lose 20-something% of people. There's just, you can't do things the same way. Some of those can be solved with money, IT systems, maybe contractors, that kind of thing, but we don't have that money. Right now, this is kind of triage, for lack of a better word, because right now it's the worst of all worlds. We're losing the people, we don't have the money yet, okay? Now, big picture, the money we're saving is not ours, it is credit union money. My paycheck, your paycheck, it's all credit union money. The gross math on this, okay, if you just divide by the pot of money that we're gonna save, a big chunk of that right off the top goes straight back to credit unions, okay? Now, we need to keep some of that savings because we are gonna hire people, there's inflation, there's other things. But right off the bat, the people whose money it is that we save should get it right back into their pockets next year, one way or the other, okay? Now, the state charters, which is a third of the system, over 1,000, they have a different mechanism for paying NCUA than the federal charters, right? The federal charters pay us for regulation and insurance. But if you just take the gross number and divide it by 4,300 something credit unions, okay? This is an incredibly gross number. Average is about $9,000, okay? So the mean, not median, mean credit union, don't hold me to it, but I think it's worth people doing their planning. It's about $9,000 divided as 40 million, let's say, divided by 4,400 credit unions. That's a gross number, right? Again, state and federal are different. I am proud that the board last year, we had a sub-inflation budget, okay? Meaning, even this year, 2025, the bills people got for NCUA, if the credit union was exactly the same size as they were in 2024, which almost no one is, but let's just say you 100 million credit union in 2024, you got your bill, and then this year you got yours. If you had exactly the same insured assets, your bill was numerically lower, not just below inflation increase, but numerically lower. Now, almost nobody notices that because you have variance in your assets year to year, and the reduction is such a tiny amount that I'm sure a lot of people have opened up their bill from NCUA or they pay and didn't necessarily, whoa, that's low. They didn't notice that, it's small. The bill you're gonna get next year, even if you don't follow anything about NCUA, and most little credit unions do not, for obvious reasons, even if they don't follow any of this, they don't know anything about fork in the road or buyouts or voluntary separation programs or any of this, they're gonna get that bill and be like, wow, that's lower, we probably all have that in some utility bills, you're like, whoa, that's real low, or something real high, it's gonna be noticeably lower. And the reason I want to talk about it today, even though it's only September, is depending on a credit union, that's enough money it may affect their planning, right? Any unexpected change affects your planning and you want to know about it. Now, an unexpected savings is a hell of a lot better than unexpected cost, but still, there's people out there who may or may not get a job at a credit union because of the savings that's coming to them, depending on the size of the savings. Okay? I just want to say that. Money is coming your way. All this effort we're doing to land this plane safely is going to result in what it's supposed to, a noticeable decrease. You're going to get a lower bill. Whether you open that email, I think we still mail some of them, right? In physical paper.
We
right?
do both, that's
correct. Yeah, we
correct.
do both, right. Whoever you see it, it's going to be, even if you don't follow anything about what's happening in DC, and God bless you if you don't. They're going to be like, whoa, wow, that's lower. Hey, we got some more money. Did you guys know about this? So that's what's going to happen. Anyway, we did our end of our agenda today. Thank you, Melissa. There being no further business, we are hereby adjourned.